Thank you. My next guest says entering 2025 feels like stepping into a house of cards. Sounds a little ominous, doesn't it? Let's bring in Market Gauge Managing Director Michelle Schneider. Michelle, what do you mean by that?
Well, we have a lot of uncertainties and yet a couple of intimations that may be more certain, like with the Fed. Let's start with them. The hawkish cut, as people are calling it, certainly sets the stage for a Fed that is anticipating fighting inflation, maybe a little too late, rather than supporting the economy because they're convinced that it's strong. And yet we know that there are pockets of the economy that aren't quite as strong. So that's number one. Number two is, of course, the big down move we've had, and we haven't actually really recovered from that yet. We had a nice day last week, but so far I could call this rally kind of meager. And then finally, I think there's going to be a lot of confusion on exactly what the policies that Trump are promising to enact, will they be enacted, to what degree, and how headline sensitive things will be based on some of the stuff that he says, which basically often is a point of negotiation, but the market takes literally.
You know, Michelle, with regard to the Fed, do we need a cut right now? For so long we lived with, such cheap money sloshing about. The question is, do we need another cut? And was that a temper tantrum last Wednesday when we got these hawkish comments?
Well, some would argue that we didn't really need any cuts this year, considering how things looked, particularly if you look at the consumer, which has remained very strong. Labor market certainly has done well. The PCE numbers have come down, but not obviously terribly low. So that's been the contention for the Fed. So one could argue that they probably should have done nothing in December and been a little bit more dovish. And I think that's what happened. It wasn't so much what they've done, because they've done a pretty good job. It's what they said for next year that I think spooked the market.
Okay, let's move on from the Fed. Looking to next year, do you see the January effect presenting opportunities for investors?
Right. Well, we look at the January effect a little bit differently. Some people will just look at the first day of the trading and then they'll use that as a range. And if things break from there or break down, they go. We actually look at it for the first 10 trading days, which makes sense even considering that we won't have the inauguration until the 20th. But basically what that does is sets up every instrument, no matter what it is, into a range that then will be extremely important, especially with a new administration, to follow, at least get you off on the right foot as we go into the end of January, February, March, and so on until it resets again. So yeah, watch those first 10 trading days. Try to be a little bit patient, which is probably not the worst idea at this point. And then when you get that range, like in 2024, if you had done that, the S&P, for example, broke out of that January calendar range and did not look back. It's an extremely powerful tool to use in 2025.
We'll have to leave it right there, Michelle, but thank you so much. Chock full of information, which we really appreciate. And have yourself a great holiday. Thank you so much, Michelle. Appreciate it.
Happy holidays.
By the way, same to you. Holiday shoppers feeling...